So we can start then. Thanks for joining in today. I'm Giuseppe Basile. I'll be your host. And today I'm going to talk about what moves price. And as you know, I'm into analyzing price through methods that model algorithms. But today I'm going to touch on different concepts and some of the other factors that move price. And we can leverage those as well. So, as you know, trading is risky. Risk is very important. If you are watching the webinar, the recording, please actually read the disclaimer here. Risk is trader's job number one. I believe once you have managed risk, you are halfway, and that's something that we have to do always, all the times, and carefully. A little bit about myself. If you know my work, you know that I'm into trading since 1999, but I really, moved forward starting from 2006 when I've been mentored by a number of people. I have some names there: Van Tarp, Ivica Jurasic, David Aisley, Jody Napoli. Recently, I received a nominee for the Jack Frost CSTA, the Canadian Society of Tech Analysts, which is the local chapter here in Canada of IFTA. And I've also been asked to sit on the board of directors of the CSTA. I have a FIPS Preparers coaching program, which is an high performance coaching program if you are interested, and I do some premium contributing activity here at FX Trade. So these are my contacts in case you want to contact me. So let's look at briefly what we're going to introduce today. I'm going to talk about some of the factors that move price, and I study algorithms and some classes of algorithms, how they affect price. And if you know my work, I have heard about this already, and I'll actually show some examples. Moving averages, some types of moving averages also have an effect on price. To me, it's not as decisive as the effect that algorithms can have on price, and today I'm going to show you some examples. However, I think it like someone actually walking against a huge crowd, right? If you are walking in a direction that is specified by algorithms, the huge crowd who is walking towards you in the opposite direction, it's what I represent as the effect of moving averages on price. So moving average tends to slow down price, and sometimes it can actually reverse price as well, but only in certain conditions and not when levels, which are played by algorithms, are actually in play. So we're going to see this concept a little bit. Divergences can also affect price under certain circumstances. I don't look at all divergences. That is a bit silly, I believe, because we can and should look at divergences only in a certain context. You cannot just apply divergences and observe divergences without context information. Of course, there is fundamental analysis, and I don't know if we'll have time to touch a little bit on that. And also timing with moving average, which is something that we might reserve for another webinar. Okay, so what are the factors that move price? Obviously, if you are into trading, and by the way, if you have any questions, just write them down, and I'll be happy to answer the questions. And Vicky, please let me know when the time is up. So there are some factors that have an immediate effects on price, and you can imagine them. Some of them, for me, and probably the most important class is algorithms. Other factors might not have that immediate, for example, fundamental factors. I'm talking about long-term fundamentals. I'm not talking about news. In fact, as you will see, I don't even mention news among the factors that can move price. Why is that? Because news can move price in the short term. What I'm looking at here are durable swing moves that we can trade. And I'm not interested in trading news because news can always move price in one direction or the other. And I don't play odds. I rather play price moves that are kind of already in the card, or the market is already following on or it's already positioned in the direction of the news. And actually, that's my belief as well. Oftentimes, you will see that, most of the times, you'll see that markets will continue or complete move or reach a target set by algorithms whenever news comes in. So news are not a factor that move price in the context of how I'm interested in trading the market, which is basically to win trades. As traders, we want to have actionable signals that allows us two main things. These are also the main objectives, I believe, as traders. First of all, to be able to take advantage of the opportunity then, because if we are not capable of deciding what to do, where to enter, have a trading plan for that opportunity that is workable, that can be applied. So we have an entry, a stop, we have a target. Then there's very little we can do, right? So we can talk about ways price is pushed around or factors that can affect price, but then if you don't have a trading plan to play that, that's very little use. And one of the reasons I don't consider fundamentals is because to me are very difficult to, are not actionable, very difficult to act upon, okay? Unless you have, unless you want to stay with a position for weeks or months, and you have deep pockets as well. The other point is to manage this properly. So these 2 points in a way describe our job as traders, and as traders we are paid for the quality of the decision that we take. Managing risk is paramount. It's as I mentioned before, it's very, very important. So indeed, we cannot ask more than these two things to the market. Okay, we don't know what the market is going to do next. If you believe you know, I think there is a big disconnect with the reality of the markets, and therefore risk management, as I always say, it's king. Attempt have to be made to enter a position when the probability of the retrace is the lowest. Right, because we observe certain conditions, we know that the market can retrace, the market starts a retrace with time, we enter the market and we put a stop below lows or above highs. And whenever we do that, we want to have, I wouldn't say assurance, but we want to have probability that low or high it's taken out. We want that probability to be the lowest. And if we can do that, then we can quickly generate a risk-free trade. And when I'm going to talk about timing, I'll talk about the concept of risk-free trade if you're not familiar with this concept. Okay? So once we get a risk-free trade, we can forget about the trade. There's no such a thing as fire and forget. I don't believe in that concept. I believe that we have to babysit the market, especially when we are entering. At least that's my approach. But in my style, once you get a risk-free trade, then you can simply forget about the trade, meaning that the trade is risk-free. You took half of it out of the market. If the market retraces and stops you out, so retraces into the stop level, which I never move, then you are out at break even minus the cost of trading, which is slippage and transaction costs. So you can only forget the trade after you get a free trade. That's why at the beginning of a trade during the inception or timing, I and probably you should babysit the market. That's my suggestion anyway. Once you get in, you get a risk-free trade, you are basically done. Now, of course, you can automate this. You can put a risk-free profit taking and put the stop and have your automation take care of that. Okay. Now, so let's look at some of the factors that move price then. Some classes of algorithms, as you know, I'm big on this. I believe that there are some classes of algorithms derived from program trading that actually move the market or are very, very important. I'm going to show some example today. But also moving average can have certain moving averages can have a big effect. Typically, they are lower number averages because the highest number leverage, like the 50%, the 20 day, the 100 day, they are reserved for effects that are more durable. So work on the weekly time frame, but of course you can apply those to smaller time frame, but I believe that there are some algorithms, couples of algorithms that describe value in money, as we're going to see later on. Divergences, fundamental analysis, as I mentioned. So let's start from very quickly. I want to touch more on moving average divergences today if there is time. As algorithms, you have seen in this a number of times, and I'm not going to go in detail here, but we have the proof that algorithms have a huge effect on maximum. This is all data. The proof also exists in price. You can have the sources here. So is our algorithm real? For those who should be able to see the charts, give me a yes if you can see the charts here. I'm sharing the screen, so please give me a yes here. Do you see the charts on the screen? I need a yes. Perfect. Okay. Okay. So algorithms. I'm going to show just a couple of examples here. I want to bring the point home. I'm not going to talk about this in detail because if you look at my other material, you will find you will find that I speak about this a lot. So this, what you see on the screen, is US dollar, Japanese yen, and this market actually is a very, very technical market, which means that it responds to algorithms, levels of algorithms very, very frequently. And I'm not going to do all the analysis here. This is very technical market. If you go back on the weekly time frame here, should have it here. So if you go back on the weekly time frame, you will see that there are extension levels that have been in play here in this market. 94, bringing pricing to the first and second target, and above that. And at some point, we had the violation of the weekly, but we had an indication of the reversal of this market once we had the violation of this sequence here. So this is lows to highs, participation of 105, first and second target hit. The next measure move actually finds participation. This is an extension. from previous highs to new highs, and we could know that with more than 1 week in advance. Price gets into the level, a lot of wicks moving laterally, and then it hits the first target there, and then we can trace the next measured move. And as you can see, again, price respects this area that is identified by these two levels, but is not capable of pushing price higher. Once we break, and there is a little break here, once we break here, then algos on the weekly time frame reverse their view, and they start trading shorts. And it's a very technical market. You know, I took this trade and I commented this trade in the FX Street Tokyo Open, and this market went into, again, first target and second target. Very technical market. The market came to trade again into the next measure move right at 111.82, and then he pushed into the first target. So the reason why I reviewed this market is because this market might be, and it is, very close to trading the next short. Okay, so you want to watch, if you're trading this market, you want to watch 110.70.80 here, which is the area where this market is coming in, and what could happen is that algorithms might come back in here and basically reverse this market. Okay, into what? We have already the target here, 103.14, but this market has the potential to retrace into the next weekly level that algos are going to test, and that is going to be lows to highs. Okay, so the reason why I analyze this market is because there's an opportunity there if you'd be trading this market, and I gave you the entry, the potential entry and level. So as you can see, when we model algorithms, we can be prepared. We can have these levels way in advance. Okay, so this is one of the major effects that I study on price, and I believe that this is the major factor that moves price. This factor has a strength that overcomes the strength that moving averages might have. Okay, so US dollar Canadian dollar is another example here, and you know, I'm going to review here the you know, we had a 50% coming into play at some point here. And then again, this market has been reusing the same trace here, the same anchor, the same start of the trace. First time into first target, then we had a second time into the second target, the second target here, into the second target, right into the second target, which shows that, you know, the levels that these algorithms are looking at, it's real. But recently we had a third trace that actually came into play here, respected the 61.8% level, and is pushing this price lower. Okay, so I'm only showing the levels and areas here. The way you take advantage of that is something different, and that's timing. Okay, just I wanted to show these two examples to remind you of the effects of algorithms on price. So let's go back to the presentation here. So our algorithm real, you tell me, the proof is in price. I can make hundreds of examples on current markets. And so I showed you some examples on the US dollar Canadian dollar and the US dollar Japanese yen. Okay. Now let's talk about the moving average a little bit. This is quite interesting, and it's sometimes difficult to factor moving averages in, so we have to do it in a certain specific way. What moving average express is market consensus, which means an agreement of what should be the average price for that market at that specific point in time. And a lot has been written about moving averages. I'm not going to talk about the different types, or only say that a price that is far from moving average is clearly extended, or it's in a maniacal state, and so what will probably happen is that indicates price will eventually retrace. Of course, we cannot just use this information for our trading, meaning that we have to be very, very precise when we look at these things in order to be able to take a decision. It's like in the algorithms, we know, in the case of the algorithms, we know the level well in advance, and we have techniques to time those levels. One of those techniques is called the Phipps-Tolkien timing technique. So when a price is really away from a moving average, let's say that this is our moving average, the market has been moving lower, and then at some point the market is here, but the moving average is there. So what we anticipate is that eventually there is going to be, a correction back towards the moving average. That's the concept here. And we know that from our experience, even if you don't have a lot of experience in trading, if you put a moving average, any moving average, you will see that kind of behavior all the time. Prices that are close to moving average means value. Players tend to buy or sell and price bounces, and we can use these behaviors. Particularly, we can use the behavior of price bouncing when moving average is near value, which means the price is near the moving average, and we can use this to identify opportunities for entry as well as for timing. Now, in order to do that, we need to show how moving average can really behave like the crowd against the trader who's trading along with algorithms. Okay, so let's look at some examples here. Now, in this chart, you will see indicators and moving average. The moving average that I use in this example are the 13 exponential moving average and the 26 exponential moving average. Why these numbers? You can use different numbers, but I like these numbers. These are the numbers that were introduced by Alexander Elder, particularly, and this level really, say something about what can happen to price. Okay, of course, moving average can and will often act as support and resistance, and that's the way we can use them for trading. However, we always have to test. Okay, you will see also two sets of moving averages here on this chart. This is the 13, and this is the 26, of course. The 13 follows price closely. The other two sets that you see here are basically the 13 and the 26 of the larger time frame. If this is the 4-hour H4, 24 minutes here. These are the 13 and 26 of the daily, which is the largest. It's not this one, this is the smaller. The daily would be the largest time frame. Okay, why do we want to do that? Because what you will see is that on your charts that market will respond to these value areas identified within the time frame, but that will also respond to the same moving averages, which are actually coming from the largest time frame. And this is very useful. And of course, there are situations where the two coincide, right? So the area that is identified by the moving average, in the same area there are also moving averages from the larger time frame. Okay, so whenever these conditions happens, there is a probability for a higher probability trade. Of course, we are not so loosely defined when we have to take a trade. There is a precise procedure to actually time these levels by waiting for the test and then moving down to the 30 minutes and wait for the timing on the 30 minutes. And only then we enter the trade. Like any level of support and resistance, moving averages can be broken, and often are, but not before they offer a bounce. And that will depend also on how steep is the current trend. And I'm going to show some examples. I'm just trying to explain some concepts here. So you also see divergences here. I'm not going to touch on them right now. I want to focus first on the moving average. But for example, you can see the divergence here. Now again, the divergence, it's very easy to see after the fact. But when you don't see this part of the chart, so when you don't see all this, right, it's much more difficult. So we need to have a way also to anticipate a divergence. So whenever we are here and the divergence is not still formed because this part here, this bar is not printed yet. Sorry, this is not showing here. So what I'm trying to say is that it's very easy to see the divergence once this bar here has been printed, okay, and the market is here already. And then you have this part of the divergence. So now you see the divergence because you have these two peaks and the second peak is lower. But the reality is that we want to be able to capture this divergence before it forms. Otherwise, it's not very useful. Okay, so let's talk about divergences later on. What I want to mention here is there are clear, well-defined, precise procedures to take advantage of these opportunities here and time them using, for example, the 30 minutes. And I can show some examples, some recent examples here in the US dollar Japanese yen, and it's better we reason on examples. So I'm going to move into another set of charts here. As you can see, this chart is quite a beauty, as I'm going to show you in a minute. And there is 110.80 is that Fibstalker level there, and that lines up with also the weekly short, the weekly average, the 13-week average here. But that's not all, because the sequence of measure moving higher has failed as well, which means that at the moment daily algorithms are not interested in pushing this price higher. All right, so if we start putting everything together, look at what a beauty this chart is. If you look at it, look at how many elements we have that could push this price lower. Okay. I already mentioned you the Fibstalker level here, which is this level 110.80. We reviewed that before, and this level is there. So this level alone could be enough to push this price lower. However, we have, weekly shorts indicated by the moving average. We have a divergence that has been printed already. We have the sequence, as I can show you on the daily, of this move higher has failed, which means that algorithms are not interested in pushing this price higher. So if algos are not interested in pushing this price higher, there is a weekly short algos, there is a weekly short from moving average, and there is a divergence. I think we have a very good case here for a trade that's a low risk trade, okay? And that's for you to look at in the coming days. But now let's go back to the effects of the effects of moving average. You want to have a situation in which the smaller moving average with the smaller period 13 is above the larger. We want to have a situation in which the larger moving average is tested. So let's look at one example here. There are plenty of examples in the last few days here, only for US dollar Japanese yen. So the number of opportunities that a methodology like this can bring are really several opportunities every week. So we have here a situation in which price gets into this longer 240 minutes 4 hour moving average, the little blue here, and the thick blue is also tested, which is a reinforcement. So whenever we see this, what you have to do, you see the test of these two. Okay, so you have to go into the 30 minutes, and the 30 minutes will show something like this. Now, as we mentioned before, so you are seeing this full 30 minutes red bar here when the market gets to the bottom here. We are seeing this market after the fact, so obviously we see the bar already printed, but when you are looking at price, you see this full red bar. Okay, so how do you take advantage of that? First of all, you have to notice one important thing. You have to notice that the 13 EMA of this chart is very far away. Okay, so there is a possibility that this market, under certain conditions, when price confirms, can actually go back and test that moving average. And in fact, that's what happens here. Okay, that's exactly what happens. It takes more time, but that's what happens. Now, the question so that you have to ask, it's a very simple question. Okay, the question you have to ask is there enough space between the entry point and the moving average for me to get a risk-free trade? Okay, that's the only question you have to put. Now, the next question is where do I enter and how, and where do I put my stop? As we mentioned, I mean, if we have a situation like this, but we don't know how to act upon this, then there's very little we can do. So an entry could be the 30 minutes breakout with a stop below lows, okay? And the question should be, is there enough space for this trade to get to that level, okay? If it is not, after the breakout, you have to wait and see whether you get a lower level of price that would justify that. What I'm trying to say here is, if the price breaks out, like it happens for this, let me make this a little bit bigger so it's. Do you understand what I'm trying to go here and what I'm trying to? Of course, you have to babysit the market in order to do that. You cannot just fire and forget. You cannot just put an entry here and a stop here and go doing other things. No, you have to babysit the market in this specific case. So we have seen that there is a test of that level, and now we say, okay, we want to enter here. However, there is not enough space to get a risk-free trade to get the same distance from the entry to the stop before we get into the level. Yes, here there might be, but you have to consider spread, you have to consider that this moving average will move towards price and so on, or vice versa. So I would say no here. So what you do is that you wait if the market retraces, and it happened that very often it does. What you can do is that you can say, let's say, enter here now with a stop below lows, and now you have enough distance to get into the level. Why we need this distance? Because As I mentioned before, this moving average will always act as a crowd that is working against price, and that will push price back. Moving average will push price back, and in this specific case, it push price back below the stop as well. That's why we need always to have a risk-free trade. What is a risk-free trade? Let's suppose that you entered at some point here, okay, with a stop below lows. You measure this distance, you add spread, and you get to a level which is your risk-free level. At this level here, you take 50% off. And you keep the stop where you initially have put it, which is this level here. Okay. If the market comes back and stops you out, that happens here, you lose 50% of your position. You took out 50% of your position. So the only expenses you have are the cost of trading, so transaction cost and slippage. Now what happens here is that this market comes back and tests this level again, so you can repeat the procedure again. Okay, this time you are luckier, and if you manage to get a risk-free trade here, you can keep this to target. Okay, and here again, here would be the entry, and the stop would be here, and at some point you get a risk-free trade here. Here, you are risk-free. You exit 50% of your position, you keep 50% of your position, and you let your position, you let your price move. Okay, so this happens very, very often, and there are ways to test when that does not happen. Another opportunity came here. The market came back into this area. The blue line was never tested, but the market came into the value area. The value area is the area between the shorter moving average and a larger moving average. Now, you might decide in your trading system to say, okay, I will only trade if the market gets to the blue line. Okay, and that's your decision. Depending on how comfortable you feel in using this methodology. But here we had the same thing. Once price tested the red line and went a little bit into the area, you had again the opportunity to time an entry, and in this specific case you would have enter is high with a stop below lows, trying to get a phase trade here. As you notice here, the market will always bounce, come back, and then eventually give you the opportunity. So you have to take that into account when you time. So entering at the first bounce is not always the best way of entering. It is best to enter when price has already tested once the smaller time frame, the moving average, the 13 moving average smaller time frame, and came back, and then it's when you can enter. Remember that you are in the context of this area of support here. So if the market comes back and does not continue lower, you can re-enter or enter and try to get a risk-free trade and then bring price higher. Okay, so that's the way you look at this kind of opportunity. Market will often respect this moving average, and the market will not be able to move lower or higher until this moving average, the bouncing on this moving average ends. So your first bounce, the market comes up, bounce, and the moving average kind of turns, rotates, and then at some point there are you will get the actual move. Right. An example is the euro pound in the last couple of months here. When you look at daily price here, and I've been looking at this market was quite interesting. There was a 50% level that came into play, and this is a classic example of a market that respects a Fibstalker level, as you can see here. 79.26 came into play, but the market could not go lower. Why? The market could not move lower because there was all this crowd who were buying on these moving averages, pushing this price higher back into the 50% Fibstalker level. Of course, the Fibstalker level is strongest. The algorithms are always strongest, right? But we will not get our move until until the value people on the moving averages will stop buying, and at some point we'll always have a large move. Why? Because Fibstalker levels or algorithms or you name it have a durable setups on price. Whenever a lot of people here trade against these levels and try to buy in this area, at that point that area becomes an area of supply. And as soon as price gets below the level, because it has to, because algos have been, the big smart money has been betting on the short side. As soon as that level goes below that box, a lot of people will need to sell, and that's the reason why you also see these moves like this. Okay. A question here: what is the 13 AMA information gives you into a 4-hour chart? What is the interpretation? It's a very good question. The interpretation is trend and support and resistance. Okay. So in terms of interpretation, in terms of traders' behavior, a lot of traders will see the price approaching the value area, and the value area is the difference between 13 and 26 in this case. So it indicates an area in the context of what price is doing at the moment where price can be sold or can be bought. Trading in the direction of the trend indicated by the moving average is always it's always the best choice unless you have stronger levels against price. If I had a Fibstalker level just below this price here, I would never sell this. So it needs to be considered in a contextual way. So in terms of meaning, it's perceived as an area of value where it's valuable to enter the market. A lot of people will see this as an area of support. Now, support is stronger when the smaller average is above the larger average, and this is just observation. Okay, so in terms of this would be the meaning. This would be the meaning of the moving average, so seen as an area of value. Any other questions? In the next webinar, I will touch on divergences as well as how we time, a little bit more detail on how we time using moving averages, which is the concept that I showed before. Okay. So if there are no other questions, I would actually close this webinar here. I hope it was interesting. Of course, the best approach, in my opinion, is when we put all this information together and we actually come out with analysis like the analysis that we have done for the US dollar, Japanese yen here. It's quite interesting. It's quite interesting to see a market that has initially on the four, we can see this on the 4 hour. We can see there are a lot of lines here. Let me remove some of the lines just not to confuse you. The question is, on what time frame are you using the 1326 MAs? 4 hour, 30 minutes, daily and weekly. So here we had on the 4 hour, we can see the sequence of measure move of algorithms. And it's interesting when the measure move actually, the support actually coincides. I don't know if you can see it here, but the Fibstalker level here, it's here, and this market actually tests the 4 hour 26 moving average, as well as there is support from the larger time frame. So when all these come together here, there is obviously a good case for a trade. There would be anyway if you were just using the Fibstalker levels with the timing. However, this of course is a reinforcement. As you can see, price gets into the first target and right into that second target, and then the traces. When it happens, it happens that the next measure move fails, which means that algorithms are not in this time frame not pushing price higher. It fails here. There are moving averages that are higher here, not algorithms. So algorithms are not interested in pushing this price higher. The market cannot move higher because there might be other players in other time frames that are moving this price higher. For example, the algorithms in the smaller time frame, smaller than 4 hours, like 30 minutes, 1 minute, and so on. So market can go higher even if there is no support from algorithms. However, this market is going into a 50% weekly that could actually push this price very, very quickly lower here. And we will see whether that happens in the coming week. All right. So this is it for today. I hope this was interesting. If you have any questions, you can always write to me, and this is my contact information here. My fibstalkertrading.com, it's still being worked on, so you will not find all the information there, but have a look at it. And if you want to subscribe to the free newsletter, you find also the link here. Thanks for your participation. I hope this is interesting. If you have any questions, just drop me an email. All right. Thank you very much. Have a good day. Bye-bye now.